So sometimes turning down the noise, not paying too much attention. I mean, obviously you still want to be aware of what's happening. You still want to be able to react to things that are happening, but not overreacting, and making sure that you're just turning down the noise a little bit can be a really important part to an investment strategy.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again at the 360 HQ, and we're talking about another interesting topics today.
Andrew, we are indeed, and favourite time of the week. I'd say it's on a Friday, but it's not Friday today. We're actually recording on a Monday, but it'll come out to our viewers and our listeners on a Wednesday. So
yeah, we're mixing it up. We're recording some episodes in advance because yours truly has got a holiday planned, so we get to enjoy some nice weather in the sun, but all of our listeners see it as nothing has changed on the podcast.
Yes, this is
some insights behind the scenes.
This is true. Although maybe you can take your laptop and recording gear and you can record an episode internationally. Who knows, right? So
international superstars.
That's it. Andrew, let's get into it. What are we talking to everybody about today?
Yeah, so today we're talking about some of those mistakes that we see a lot of investors make. So we're going to highlight what those mistakes are, and hopefully provide some insights so that all of our listeners don't make any of these investment mistakes when they're on their own investing journey.
Yeah, and I think that's a really critical one in terms of where we're at. Just in terms of the cycle, I mean, from our perspective with our clients, we're definitely seeing a greater sense of awareness around the need to invest. And I think that comes with a couple of things, but in particular with inflation, because inflation has been so high that we haven't seen it like this for a long period of time. People are like, okay, how do I maintain my purchasing power? And the answer to that is obviously you need to grow your money in line and above and beyond inflation. So we're starting to see a lot more of it in the people that we're talking to. So yeah, really timely and really fitting episode. Andrew, let's rip into it. What do you reckon the first one should be that we should think about?
Yeah, look, I think the first one and the starting point of any investment is making sure that you've got a long investment time frame. Having too short of a time frame is probably the easiest way to make mistakes in other ways. If you're, investing and you're thinking, hey, I'm going to put some money aside and I'm going to, grow my wealth, and in 6 months' time, I'm going to take that money, I'm going to put it here. It's just not long enough of a time frame. And you might be able to make some good capital growth. You might be able to make some money, but if your investment time frame is too short, I would argue that you're probably not investing and you're, gambling. I mean, that's probably a harsh way to put it, but there's too much volatility associated with it. So you really need to make sure that if you're investing, you've got a long investment time frame in order to be able to ride the highs and, not need to sell on the lows.
Yeah, and look, I think that's a really good conduit into the one that I wanted to talk about as well too. Having realistic expectations is probably the one that I tend to think of, at least initially in the conversation piece, because if you decide to invest and you've got a spare $2,000 a year and you invest that into something, even if you get a rate of return of 10%, so 10% is a good rate of return, but 10% of $2,000 is only $200. Yep. So you're not going to be able to turn the 2,000 into 4,000 and so on and so forth, probably, along the lines of gambling and spectating and all that sort of stuff. But I think having a realistic expectation about what's possible is definitely a great starting point, because if you start with that then converts your thinking to a long-term time frame, because in order to turn that $2,000, might be a $2,000 lump sum in this hypothetical example, and then maybe dollar cost averaging on an ongoing basis over a long period of time, once compounding does its magic, that's when you really start to see some absolute numbers turn into something exciting as those balances get bigger and bigger and bigger. So I think having realistic expectations, at least heading into this, and knowing what's usually or normally possible, I think is a really great starting point.
Yeah, exactly. So, don't expect that things are going to go gangbusters, and make sure that you're looking at, what's happened historically in order to formulate your strategy, formulate your plan, and essentially align your expectations. Because unfortunately, which is probably another one that we like to or wanted to introduce in this, when your expectations are too high, it can mean that you're putting yourself into a position where you're chasing trends. Mm-hmm. You're chasing something that's, really attractive at the moment. Everyone's jumping in on it. You get into a trend and all of a sudden that bubble's burst and you're the one that's left holding the bag. So making sure that you've got realistic expectations is a really important one. And also very important probably at this time as well is it's sometimes better to not be too invested, if that makes sense. So turn down the noise. You turn on the news and there is always a story about either the market is going so hot and you're missing out on an opportunity, you need to get in now, or the market is bursting and you really need to sell all of your investments in order to avoid any of the crash. In reality, it's probably very few times that you're at either point, and it's realistically somewhere in the middle. So sometimes turning down the noise, not paying too much attention. I mean, obviously you still want to be aware of what's happening. You still want to be able to react to things that are happening, but not overreacting, and making sure that you're just turning down the noise a little bit can be a really important part to an investment strategy.
That's probably the best piece of advice that you could give anybody, I think, when it comes to investing. And if you think about almost anything in life, there's probably reasons to do it, and there's probably just as many, if not more, reasons not to take a particular course of action. And one of the analogies that I tend to think of and tend to talk to clients about is that I don't believe that you can play the game and always expect the weather to be perfect. So what I mean by that is that you can't expect, it's unrealistic to participate in investment markets that do experience volatility, because that's just the way that businesses and the economy works, and only participate in that when things are going well, when the market's going up and you're not experiencing any of those things. It's just unrealistic, and it's never going to happen. Yeah. And if you're paralyzed by all of this stuff that's thrown at us in the media and stuff that we see online, you won't take any action. And actually, that's probably one of the things there about, you've mentioned that about not investing. We'll talk about that in a sec, but definitely turning down the noise and ignoring that as best as you can, because there's always something around the corner that's going to harm us. And I don't know, maybe that's our nature from being hunter-gatherers back in the day. We're always waiting for that lion to jump out of the bush, so we're kind of expecting it. But you just need to turn down the noise, and I think you just need to do it.
Yeah, exactly right. And I mean, truth be told, you need to expect that there are going to be times where your investments will go down in value. Yeah. I mean, there's never been an investor, other than maybe someone who's only invested once and they won and then that's it, they never invested again. There's never been anyone that's successfully invested over the long term and not made any mistakes, or not even made any mistakes, like not lost any money. Yeah. That's part and parcel of investing. So you need to make sure that your expectations are that, hey, there's going to be some losses, there's going to be some wins, and so long as the wins outweigh the losses and that's happening over the long term, then I'm in a fine position, I don't need to worry. But if you're paralyzed by the fact that I cannot make a loss on any of my investments, then it's probably not the right thing to be doing. And your expectations should be either in, putting yourself in investments that don't have the ability to lose, putting yourself into term deposits and expecting that, hey, the rate of return is not going to be, what I expect it to be. And I either need to invest longer or invest more in order to be able to achieve what I want to achieve. But you need to have the expectation that there will be losses. That's a part and parcel of, an overall investment strategy. Yeah. So turn down the noise, and when there are losses, that's fine. That's either an opportunity to invest, or it's okay, we're going to ride that out and essentially make up those losses at a future point in time once the market recovers. Yeah,
no, well said. And look, I think where this tends to lead to is around risk and the expectation around risk, and being, it's going to sound funny here, but being realistic about risk and knowing that that's part of the game. And how do you then have, as part of your investment, and your investment strategy, how do you then have a mechanism in place to try and manage that risk as best as possible, which leads us into the next thing around diversification. Yeah. So wanting to make sure that you've got a good spread of different asset classes that are exposed to different parts of the economy. And the theory behind it is if one particular part of your portfolio that's exposed to one particular part of the economy is not doing well, then you've got the other parts that are diversified that are supporting that. So I think having a good, robust portfolio that's diversified across different asset classes is definitely a way to give people comfort. It helps people turn down the noise. It helps people develop part of a risk mitigation strategy of their portfolio. And plus the education piece that you get to about being invested in different asset classes, I think definitely helps. And that probably helps then shape that realisticness around what asset class is going to achieve what rate of return as well too.
Yeah, and I think mentally it makes a big difference when you're seeing all of your assets in one asset class that may be declining in value. It can be a pretty big shock. I mean, 10% or 15% of your overall portfolio is a significant amount of money. Whereas when you're talking about that, impacting one part of your investments, but you're also seeing the other part of your investments that might be doing well, that might be supplementing that in terms of, some of the negative growth that's happening there. It's a lot easier to continue the course. It's a lot easier to say, hey, you know what? It's okay, because even though one part of my portfolio may not be doing well, the other part is. And that's ultimately part of the game. So diversifying and making sure that you've got a multitude of assets can be a really good way to reduce some of the underlying risk in the portfolio and give you options. Because if you're at a point where, hey, I need to sell some of my assets, you're probably not going to want to be selling the assets that have recently declined in value. You want to be selling the assets that have done well so that you've got the opportunity to allow the investments that haven't done as well to grow and realise some capital growth. So having a diversified portfolio can really help facilitate that as well.
I love the next one, Andrew. Time in the market versus timing the market.
Yeah.
So this one, look, let's unpack this a little bit. But if you look back at a graph on any particular asset class, on any investment, you look at the lines and do this, and it's really easy to turn around and say, I would have done this at this particular point in time, and it's down, so I would have bought, and it's up, so I would have sold, and bits and pieces like that. But that's never the case. Trying to time the market, crystal ball stuff, bit of black magic, bit of voodoo, I don't know what's going on there, but it's impossible to do. It's impossible to do. So how do we overcome that? We continue to put in on a regular basis continual amounts of money for a long period of time. So time in the market, and there's some numbers and statistics around, if you're trying to get in and out of the market and you miss the recovery days and all of that sort of stuff, there's a whole heap of literature on it. But the idea is get in early and stay in for as long as you possibly can, as opposed to trying to pick certain entry and exit points. It's damn near impossible. The only thing that sort of comes close to it, in at least my experience, is when you see an economic shock type of event. COVID in March of 2020 and the markets fall off a cliff. And you've got to have the gumption to be able to do that, but that's a buying indicator to basically say, yep, things are cheaper than they should be.
It's a good time to buy into the market.
Any other time outside of that, it's almost impossible to try and pick. But getting in and staying in, time in the market versus trying to time it in and out is definitely one way, or one thing that we recommend that with all investors, it's a lesson that you should be learning and you should apply, because the other way is almost impossible.
Yeah, and look, you also need to consider, which is one of the next points, but the opportunity cost of not investing. So not investing, many people think about it as, yep, I'm at a neutral point, when in actuality, there's an opportunity cost of, had you gotten in, the market's gone up and you've missed out on that growth over that point in time. So even when you look at the scenario of, hey, markets are down, time to purchase assets and put some money into markets, well, you still need to consider the opportunity cost of, hey, what if I had just already put the money into the market and I had ridden it out? That decline might still be higher than your entry point would have been if you had just gotten in earlier. So trying to not time the market is really important because it's impossible to pick the highs and pick the lows. And equally, making sure that you're not paralyzed, sitting on the sidelines and not investing is, in essence, another form of trying to time the market.
Yeah.
So ensure that you're doing it on a consistent basis, take the think work out of it, and provided that it fits into your long-term strategy and you've got the time frame of investing in good assets, then there's ultimately no reason not to.
Yeah, and when we think about risk, not investing, procrastinating, dragging your feet is actually a risk within itself.
Absolutely.
You know, we spoke about keeping up with inflation and the time value of money and your purchasing power, but that's a huge one as well too. And maybe not necessarily from an investment, like an asset class perspective specific, except around property. Like the one that I hear a lot of is that, you know, I'm waiting for the property market to crash and then I'm going to buy in. That one is challenging because it goes up and then it comes down a little bit and so on and so forth. But not investing, there's a risk within itself as well too. And I think you're doing yourself a disservice around that. The other one that I hear around the not investing part is just that I don't understand it or I don't trust it. That's always an interesting one as well too. And I think with a little bit of education, you can kind of almost answer those ones to a high degree of satisfaction. But yeah, not investing and coming up with these things that you're putting sort of mental roadblocks in your place, in front of you, I think is a really big challenge because you don't want to be not investing because that's also a risk as well too.
Yeah, and look, there's a bunch of financial planning firms, I mean us included, that they'll have a consultation that's initially complimentary. So sometimes the biggest barrier for most people is I don't understand it. It doesn't really make a whole lot of sense to me. And so I'm just going to avoid it in order to, not consider it. And then eventually gets to a point where, okay, I need to actually speak to someone and look at getting some advice. And not that it's too late, but had you started 5 or 10 years earlier, the impact would have been completely different. So sometimes it's, hey, reach out to someone, have a conversation, educate yourself. And if you're still not comfortable with it or you still don't think that it's right, then that's fine. At least you've left it with more information than what you otherwise would have. But sitting on the sidelines and not making a decision and continually putting it off, unfortunately, the opportunity cost associated with that, even though you can't recognize it immediately, you look back and the opportunity cost is massive.
I mean, look, talking about doing that takes a high level of self-awareness, and I think that's a good roll into the next one around controlling your emotions as well too, because, it's amazing how emotional we get around things like money.
Yeah.
And once again, I'm going to butcher the statistics here, but the magnitude of the felt impact of a loss versus the felt impact of a gain, it's like 10 to 1 the other way, meaning that you feel a loss 10 times more or something like that than you feel the gain.
Yeah.
I'm definitely botching those figures up, but
it's all right. You say it with enough confidence, and it's a true statistic.
You get an idea of what that is, right, and how that rings true. But if you can control your emotions in investing, it's definitely the way to go. When you're making these decisions, it is from an investment perspective. So you need to take the emotion out of it simply because you don't want your decision clouded when certain external factors happen. Because otherwise it just clouds your judgment and you're going to make mistakes. Yeah,
exactly right. So make sure that you're, as best as you can, controlling emotions. And sometimes the easiest way to control your emotions is, some of those earlier points, like just turn out the noise, make sure that you're investing consistently, you take the think work out of it, and all of a sudden you're not needing to make a decision every time, and you're not needing to, think about, hey, is this still the right thing? Is it not? It's just set and forget. So sometimes, the easiest way to control your emotions is to almost forget that it exists.
Yeah, I mean, I like the set and forget thing, and probably one step further with not only controlling controlling your emotions is difficult, and it's hard to say how you will react once a certain set of circumstances are presented to you. I think if you can engineer your environment, and I'll explain what this means in a sec, but if you can engineer your environment to a certain way, taking your emotions out of it gets easier. So let me explain. If you're investing regularly in the market and you're dollar cost averaging, then it really doesn't make too much of a difference what the market's doing, because you're buying in the moving average of the underlying share price. If you've got a good financial position where you've got, a banking strategy in place, you've got emergency and liquidity funds, you've got secure employment, you've got, your insurances in place, you've got a debt elimination strategy if you've got a mortgage, and you're ticking all of these boxes, I think it's a lot easier to say, yep, I'm comfortable with where I'm sitting, so I can take my emotions out of it because this is my plan, and I know that that's the case. And as a consequence of all of that, I know that I can just turn off the noise. I don't even need to look at this thing because I'm just doing my thing, and I know that over time the probability is, if we look at investment markets, the probability is that I'm going to grow my wealth over the longer term. And I think that's the way to really tick that one off the list, is just engineering your environment, as opposed to saying, yep, I'm going to be mentally strong, and when the markets drop, I'm not going to look and, bury my head in the sand type of thing. It's really hard to do.
Yeah, exactly right. And look, I think it all boils down to, having a plan and having a strategy. So it's all good and well to, take some money and put that, into growing your wealth, which is fantastic. But if you don't know where you're heading, if you don't know why you're doing it, if you don't have a plan associated with all of this, then it can be really hard to do all of the other things, because you don't know, where you're heading. You don't have that long investment time frame. Your think work is constantly at, hey, maybe I need to sell out of it. Maybe things aren't doing well. Maybe I need to, make an adjustment. But if you've got that long-term plan, if you've got a strategy, if you know where you're heading, it makes it far easier to do all of the other things. So, get advice, speak to a professional, whether it's something that you then take that and manage it on your own, or whether it's something that you actually engage in fully fledged advice, is completely up to you. But at least having a broad strategy, at least knowing what you're doing, at least making sure that what you're doing is the right thing to be doing, and that there aren't better ways to structure it and make sure that your plans more closely aligned to what your goals are. I think having an investment plan is the starting point before you do any of the actual investing side of things.
Yep, no, definitely makes sense. I mean, look, it's a lot. There's a lot more to unpack in that than just invest, throw money at it, and hope you've chosen a good investment option. But building a robust investment philosophy, investment strategy that's sustainable, that's realistic. They're the steps that we think about when we go through those with clients, right?
Yeah. Absolutely. Bills, I think that does the episode a bit of justice. So hopefully we've helped people not make some of the mistakes that a lot of, at least first-time investors make when they get started on their journey, and hopefully we've armed people with a bit more information than what they otherwise would have.
No doubt. And you know what? If all of that sounds too hard, just hit up the show notes, give us a call, and we'll sort it out for you anyway. So. Yeah,
absolutely.
To our viewers and our listeners, thank you once again for your attention. Hope you got a fair bit out of this episode. Feel free to pass this on to a family member, get them to like and subscribe, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.